Hi there, Adam Walcombe here, just with a brief update on how we're thinking about the end of the tax year. April 5th marks the end of the tax year and April 6th marks the beginning of the new tax year. And every year there is a series of different tax reliefs available for every UK resident and investor. And so we want to make sure as part of our planning that you actually consider and potentially use all of those potential reliefs available to you. We have a good summary on our blog, so if you can see, if you go to our website and want to read it through, it's on News Hub, which is one of the top things up there. Click on that and we've got a section on end of year tax planning. So this kind of gives you the main highlights, which I just want to run through with you today. So when we think about tax planning for this year especially, the one tax relief or allowance that is the most relevant for this tax year is capital gains tax. And this is because the CGT rates, or excuse me, the CGT allowance is coming down in the next tax year. So that the current capital gains tax allowance is $12,300, and this will be cut to $6,000 for the next tax year. And then for the following tax year, it will be cut to $3,000. So for a family, or if you consider for a couple, this is almost approaching $25,000, and then this is going to be cut as an allowance to about $6,000 in a couple of years' time. So making the most of this, using this capital gains tax allowance is one of our key priorities for this year. Now, capital gains tax is clearly tax on what you pay on for investments. That is for a higher rate taxpayer, that is 20%. On property, investment property is 28%. And so when thinking about what to do, you can't just sell out of a fund and then buy the same fund back again. That you actually have to sell out of one fund and buy a different fund, or you have to sell out and move to cash for a moment. Now, if you've got any questions on this and how you should think about this, please get in touch and we can talk through this for this year. But please note, this is only relevant if you've got what's called a general investment account or a GIA. For ISAs, there is no tax, there is no capital gains tax on ISAs, or pensions the same. There is no capital gains tax on pensions. So for ISAs and pensions, this is not relevant. It's just relevant if you hold a general investment account. The second key part to note about the end of the tax year is the additional rate. So the 45%, that threshold comes down from 150,000 down to 125,000. It's a funny number, that 125,140. But if you remember, this is where, so for every earner between 100 and 125,140, that's where your personal allowance gets cut. And so really in that, if your earnings are in that bracket between 100 and 125,000, you're actually a 60% taxpayer for that. So taxes are quite high at the moment. Dividend allowance has been cut to 1,000 from the current 2,000. And on the flip side, on the positive side, for anyone who's receiving or about to receive a state pension, and frankly, when we consider about to receive, we're all about to receive a state pension, it just might be many years away, that state pension has gone up by 10.3%. So that's a bit of positive news for us. So what can we do? And what are the things that we're advising? So we've got four main points that we talk about here. The first is pension contribution. So especially if you are, let's say, 45 and above, the pension contribution becomes a more and more valuable. The key reason why we picked that sort of 45 age bracket is because if you put money into your pensions, you cannot touch that money until you're at least 55. Now, for anyone like myself who is blessed to be 45 and slightly above, the time before 55 gets lower, gets less and less and less. So that, as a downside in your pension, gets better, or the downside gets less and less. So consider your pension contributions for this tax year. CGT allowance, I've briefly discussed. ISA contributions, I've talked about ad nauseum for everybody. ISAs are brilliant. They form the cornerstone of every investment plan. It's £20,000 can go in every year, use it or lose it. And once money's in a pension, everything about that money is tax-free forever, which is fantastic. Growth, interest, dividends, etc., always going to be tax-free, which is brilliant. And then finally, we're thinking about entrepreneurs and business owners. So if you run a limited company, you can make that pension contribution from the limited company as an employer contribution into your personal pension. That is the cleanest way to get money out of your company account, because £100 goes from your company account, £100 goes into your pension. There is no tax involved in that because it is a gross contributions, and pensions sit in a gross tax environment. And so there are just a few ideas when we think about end of tax year planning. Always a busy time, but if you've got any questions, please feel free to reach out and we can help you. Thank you. Bye.